There's a number I want you to hear, and once you hear it, you can't unhear it. In 2024, the average equity investor underperformed the S&P 500 by 8.48 percentage points. The market did its job. The investors didn't. And that's not a one-time fluke. DALBAR has tracked this gap since 1985, every single year. Same story. The market gives, investors give it back. So today, we're ripping off the Band-Aid. These are the uncomfortable truths about investing that nobody wants to tell you, but you absolutely need to hear if you want to build real wealth. Let's start with the big one. You are the biggest threat to your own portfolio. Not the economy, not inflation, not the president. You. According to JPMorgan, over one long 20-year stretch, the S&P 500 returned around 10% per year on average, but the average investor earned just 2.9%. Same market, same opportunities, wildly different results. And the reason is behavior. People panic sell when the market dips. They pile in when prices are already sky high. They chase hot tips from coworkers and strangers on the internet. Then they wonder why their account is bleeding. Here's the second truth that stings. Doing nothing is not safe. A lot of people say, I'm just going to keep my money in the bank. At least it won't lose value. But that's a lie your brain tells you because it feels safe. Right now, U.S. inflation sits at 2.4%. That means every single dollar you leave sitting in a basic savings account is quietly shrinking. $1 million in 2015 now needs $1.32 million to buy the same things. That's a 30% loss in purchasing power in just 10 years. You didn't spend it. You didn't invest it. You just let it sit there, and it rotted like fruit on a counter. The uncomfortable truth is that cash feels safe, but it guarantees you lose money slowly. The only question is how much you're willing to lose by standing still. The third truth is about timing. You don't need to find the perfect moment. You need to stop waiting for it. Here's what the data from Capital Group actually shows. If someone invested $10,000 at the absolute worst time every single year, picked the market peak every year for 20 years, they'd still end up with an average annual return of over 12%. Waiting on the sideline cost more than buying at the worst possible time. Let me say that again. Being in the market at the wrong time still beat being out of the market entirely. But millions of people are sitting on cash right now, waiting for some magical green light that never comes. They're watching TikTok, reading headlines, refreshing stock tickers, and convincing themselves that research is the same thing as action. It's not. Research without execution is just procrastination wearing a smart disguise. And that connects straight to truth number 4. Time is worth more than money. Most people think investing is about picking the right stock. It's not. It's about giving your money time to compound. Someone who invests $200 a month, starting at age 25, at an average return of 8%, ends up with roughly $700,000 by age 65. But if they wait until 35, same amount, same return, they end up with only about $300,000. 10 years of delay didn't just cost them 10 years of contributions. It cost them $400,000 in compounding. That's the part nobody tells you. You're not just losing what you don't invest, you're losing what that money would have earned on top of itself for decades. Now, here's the fifth uncomfortable truth. Most people think they'll catch up later. According to Bankrate's 2025 report, 58% of American workers say their retirement savings are behind where they should be, and 54% of American households have no dedicated retirement savings at all. That's not a small gap. That's a crisis happening in slow motion. And the reason is always the same. People tell themselves they'll start next year. Then next year becomes the year after. Then a decade passes. And suddenly, the math doesn't work anymore. Less than half of people currently saving for retirement are even on track to maintain their current lifestyle, according to Vanguard's latest data. That means even the people who started are falling short. So, if those who took action are still behind, imagine where you'll be if you haven't taken any action at all. Truth number 6. Diversification isn't exciting, and that's exactly why it works. Your brain wants the thrill of the moonshot stock, the one ticker that goes 10x. But JPMorgan's own 2026 outlook warns that concentration risk is rising. When you bet everything on one sector, one stock, or one trend, you're not investing, you're gambling with your future. The boring, balanced portfolio of index funds spread across sectors and asset classes has outperformed the vast majority of professional fund managers over 20 years. In fact, 92% of large-cap fund managers failed to beat the S&P 500 over that period. So, if the pros can't do it, what makes anyone think they'll outsmart the market by day trading on their phone between meetings? And the final truth, the one that ties everything together. The market doesn't care about your feelings. It doesn't care if you're scared. It doesn't care if you're excited. It doesn't care if you just got a raise or just lost your job. It moves based on earnings, economics, and the collective behavior of millions of participants. And the people who build wealth are the ones who stop trying to control what they can't and start controlling what they can. That means automating investments. That means ignoring the noise on social media. That means setting a plan and sticking to it, whether the market's up 20% or down 20%. It means treating your brokerage account the way you treat your electric bill. You don't debate whether to pay it this month. You just pay it. Make investing that automatic, that non-negotiable, and you remove the emotions that destroy most portfolios. Here's the bottom line. The uncomfortable truth about investing isn't that it's complicated. It's that it's simple, but emotionally hard. And most people lose not because they don't know what to do, but because they can't stop themselves from doing the wrong thing at the wrong time. If this hit home, subscribe to Frankie Finance. We break down the money truths that actually move the needle. No fluff, no hype. Just the real talk you need to hear to take control of your financial future. Hit subscribe, turn on notifications, and I'll see you in the next one.